Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Well, that's a great quote from Sir John Templeton. This is Andy O'Fee, the Yankee closer from Crump Mortgage. And this is part two of my 2021 outlook in regards to mortgage rates. And today we're going to talk about the stock market. And please don't take my opinions on this to go out and do anything dramatic with your portfolios. I would encourage you to speak to your financial advisors who are the professionals in that field. My comments are directly related to what I think the stock market our stock markets are going to have as far as impacts go as we go into 2021. But Sir John Templeton's quote was certainly something to think about as we go back and look at it and think about how things are so euphoric right now. We're actually starting a phase two of a bull market, and we're starting to see stocks again hit record highs. And we have to understand that potentially going into this year, we could be getting set up for some sort of correction, which in event would occur that would help our bond rates as well as our mortgage rates. So I want you to think about that. Think about a little tip too, that when people start talking about bull markets and bear markets, I don't think a lot of people understand that, but when a bull attacks, it raises its horns up, which is a bull market going up. And when a bear attacks, he puts his claws down and claws down. So thus you have a bull market and a bear market. Just a little tip out there. Not a lot of people knew that. So let's go ahead onto our next presentation here. And I'm going to tell you something that's pretty incredible. The Citibank Panic Euphoria Index now, again, we tracked this a couple of months ago. And again, we are at an all-time high of 1.89%, basically letting everybody know that, hey, everyone is so happy to be in the market. A constant data piece of 0.41, anything above that is simply telling you that, wow, we're going to really be doing incredibly well and then potentially getting set up for some sort of correction. Now, if you look at those numbers versus where we were back in the dot-com era, back in 98, we did see that huge correction right at the beginning of 2000 where the stock market dropped all the way back down below the euphoria index to a panic area. And then once we got back into the panic area, like I said, people have a tendency to kind of throw money back into the market. So let's talk about Joe Kennedy and the Shoeshine Boy, because this is really a very compelling story. And it is historically true that when Joe Kennedy, during the big stock market boom back in the 20s and the 30s, was out and his Shoeshine Boy started talking about stock tips, at that point he started thinking, wow, if guys like my Shoeshine Boy are telling me which stocks to buy, then I got to think that, wow, this thing is really kind of getting out of control. And that leads into the next presentation slide, which is Robinhood, where you've got guys out there that really don't have any experience in the market at all, throwing money into the market. Take a look at what happened with Reddit and GameStop, how the social media platforms were able to manipulate the market. Basically, everyone is putting their money into the market right now in hopes of a quick return and a quick killing. So we got to think about that too. Is that going to continue as far as this trend goes? Now, we have to look at also some of the things that are going on with the data points that are very, very factual as far as the S&P. If you look at valuations across the board, everything is at historical highs as far as the valuations being 100% of their value. So stocks are on the expensive side. And are we going to continue that road? Honestly, it's very difficult to pinpoint that. I would think that if we could, it would be great. Vaccines are rolling out. We still have a billion plus jobs that were lost during COVID and that they need to be replaced. So what's going to happen once we get through these cold months and into the spring, and ultimately more people are getting vaccinated? Are they all going to be getting back to work? And is that in turn going to continue to stimulate the stock market and the economy? Well, we all know if that happens, then we've already started seeing it in the last couple of days in the bond market where rates have started to rise slowly. And if you look at my previous presentation, I told you that throughout the year, we're going to get into some bumps in the road where we're going to see rates go anywhere between a quarter to a half a point higher from the lows. Now, we're still at sub 3% at this point, but as the trend continues to move higher, then we have to be prepared for those higher interest rates. So let's just keep our eyes on the stock market. It is a very, very good barometer as to where we're going to go with rates, because money, when it flows out of the stock market and it goes into the bond market, we see yields get pushed down, and then in turn, that helps our mortgage rates. In the meantime, enjoy the mortgage rates where they are. we're in great shape still. There's still pent up demand for home buyers. And again, they may not be getting the lows on rates, but they're still able to take advantage of these numbers, which again, at 3%, even if it gets to that point, it's still a number that you can tell your grandkids about in 50 years when rates are 15 or 20% at that point. This is Andy O'Fee. I hope you enjoyed this. If you have any questions, we're going to do part 3, and we're going to talk about inflation the next time, which is something we really need to keep our eye on as the market continues to heat up. Thank you so much. Get warm and enjoy the snow. Bye-bye.